Today is Daniel McAdams. Daniel, good to see you.
Good to see you, Dr. Paul.
There was a report out today on employment, and it did not meet expectations, so it was slightly worse than they expected. But it wasn't a disaster. It was the first time jobless claims came out, and the jobless claims went up 15,000. That's not a whole lot, because the total number still stays below 300,000, and that's considered not a real weak economy. So even though this had a temporary reaction that there's maybe some weakening there, it's really not that bad. But they expected 275, and they got 295, and that plays a game, with the marketplace. But the continuing claims went up 69,000. So there's a figure there that that's a longer-term indicator. So people are not getting employed, and of course the Fed's complaining about they're not making a whole lot of money, and therefore they're getting hesitant. But the continuing claims, people who are continually getting these claims, it's 2.3 million. But a lot of them probably have given up, and that's why a number that we've been looking at a lot more is the labor participation rate. And it used to be that only the esoteric web pages carried this, but it's only on the business news now, and it is significant because if you look at that chart, the numbers show that the recovery didn't do anything but drive everybody into non-participation. But guess what that did? That last week the figure showed exciting news: 5.3% unemployment rate. Man, the whole problem is over. But still, the Fed doesn't come through and say, well, it's time to raise interest rates.
Seems like they deliver good news. They want everyone to think everything is doing well, but they don't want to do what the good news implies should be done.
That's right. And then the market players sometimes know it's bad news, but they think the spin will be good for the markets. So those short-term plays, aren't as important as the long-term fundamentals. The participation rate is one of those. But last week when they did those reports, they said there were 293,000 new jobs. Wow, that's good.
That's
so
great.
that was positive. But when you dissect it out, and thanks to Zero Hedge, who does a very good job on sorting this out, that the part-time jobs were increased 161,000. That's where the big thing came. And you say, well, maybe the rest of those were the full-time employment. Full-time jobs went down 349,000.
They decreased.
A decrease. They went down. So it shows that the economy remains weak, and yet the stock market is doing well. The plunge protection team is doing well. But now, and also last week, the number of people, the people who are non-participating anymore, that total number is up to 93, almost 94 million people aren't participating. And just last week, when all these good numbers came out, 650,000 of them went into non-participation. So that's, I don't know how they get away with spinning this as great news.
What does it mean, non-participation? What do these people do then for the day?
Well, it's a mixture. Some people maybe retired early. Some people might have been looking for jobs, but then they drop out looking for jobs. Some people may be on disabilities, and maybe they were pushed into disabilities for economic reasons. So it's a mixed bag, but it's a hit. By that chart, you can see that historically this is very, very bad and doesn't look good for the economy. So, and this is the reason why I think the Fed is not about to raise interest rates. I predicted they won't, but that's just my thoughts, because they know what we're talking about. They know that things are weak, and they also keep thinking of 1937 because they blame the Fed for extending the Depression by continuing to regulate the economy, which delayed the correction. So the Fed has not responded yet, and they're also waiting. They want to wait. This always to me is so ironic. A Fed official will say, well, we're not quite ready to do this because what we're really looking for is inflation. We want to see the prices going up. We want to see currency destruction. We want to see more discouragement for people saving. We want to hurt the elderly who save money. We want to punish the people who are frugal and want to take care of themselves, because we need to destroy that money at a greater, by government statistics, more than 2% rate. But it's already being destroyed, I think, for certain people much faster than that when you look at utilities and doctor bills and food products.
Yeah.
So I think that's going to delay them from doing anything. But internationally, this has some significance too. You wonder about maybe what we should look at the Chinese market.
It's interesting because the Chinese have been relatively hands-off on their economy. That's the one thing that characterizes communist China, but we saw this past week that they've come down with kind of a heavy hand after the bubble feels like it's...
Well, when push came to shove, they were true Keynesians, that they believe, of course, they would be more tempted for central economic planning. They never gave up government intervention and planning, but they had at least adapted to some of the Western thoughts on a freer market, but they have all been sucked into believing that economic planning can occur through monetary manipulation. And once again, they encourage people to buy stocks just like our government does, and we protect the stock market, and you get it up, you get a bubble, it's malinvestment, it's not true wealth, and when it starts to break, I see the Chinese are a little bit more authoritarian when they come to solutions than we have been.
If you short your stocks, you go to jail.
Yeah.
But can they contain this? What's the ultimate?
No, for a short while, as we speak, the Chinese market responded to this thuggish approach. Don't do it or we'll put you in jail, don't sell. And probably the people who are true traders say, hey, market might go up for a couple of days, and they go in and buy this, so the markets, go up very rapidly. And but it cannot be contained. The bubble always bursts, and we're back. I'm impressed with the ability of our central bank to reestablish so much of a bubble economy after the collapse of 08 and 09. But they weren't able to restore sound investments and real growth in labor, but they were able to restore growth and money making in the financial markets. And of course, this is why there's such a political division now. The division between the middle class and the poor versus the people who really get the benefit. I think that is going to be the key issue in the campaign. We hear a lot of noise right now about immigration and other things. I wish they'd talk about more about specifically about the Fed or the foreign policies issue and these things. But I think the real issue will be the demagoguing that goes on when you see a Bernie Sanders doing well, and here he's an avowed socialist, and once again it's the inequality of income. Well, there is a lot of disruption in that, which we've talked about. But it comes from the Federal Reserve. But if you're an interventionist, you come in and we're going to change this. This group isn't getting a high enough wage, so we're going to mandate a wage. Oh, you used to get $7, $15, and we'll solve all our problems. And that doesn't work. They're resorting to economic planning. But I think that's going to be the big issue, whether it's the Democrats or the Republicans, and they'll have a different twist on it. But unfortunately, both parties generally have supported intervention. One said we want to redistribute wealth and give it to the poor and give them free houses and free medical care. But look at what happened to all the free houses, and look at what's happened to the educational system. So that doesn't work. And the other side might say, well, we can solve all our problems by deregulation. A lot of deregulations we should have, but there's more to it than that, because it's the business cycle that they have to deal with, and they have to deal with the Federal Reserve. So, but time will tell, just what will happen here. But I think it's moving quickly, because we have China to deal with. We don't know exactly what will happen there, but The big thing going on in Europe is Greece, you know, and every week there's a solution, you know. Okay, there's going to be a vote this weekend, this is going to decide it. But this has been going on for 5 years.
Yeah.
And then there's a crisis the other day when there was a so-called solution, you know, it happened, I think it was a swing of 650 points in one day, 300 up and 400 down, it was up and down. And that is not what happens in a stable, free market economy. Things are based on real value. But now it's purely a bet on trying to understand what the next move will be on the Fed and anticipating how these market players are going to react and what will happen. So they're a long way off from having a solution. And it's just too bad that we don't have a greater emphasis on understanding free market economics and how the Federal Reserve has created this monster and how we tend always to bail out the rich with the pretense that we're going to take care of the poor. That's what's going on in Greece. Yeah, there were a lot of people with their hands out in the welfare state, but the big guys were ripping them off and making these loans. So the ones who, where was this money coming back to make all these loans to Greece? It came from the central banks and easy credit, just like it is in this country. So until we understand monetary policy, the business cycle, central banking, and why big government is almost always our enemy, and the government should be there to protect our liberties, not to run our lives, and not to run the economy, and not to police the world. When we come to that point, believe me, we at least could establish peace and prosperity for this country. But if the world would accept those principles, believe me, it would be a much better place in which to live. I want to thank everybody for tuning in today to the Liberty Report, and please come back soon.